go.
Streaming from South Africa to the world. This is the Stonks Go Moon podcast. What just happened? We break it down so you don't have to.
Welcome everyone to the Stonks Go Moon podcast. My guest today, very big guest. His name is Alfonso Peccatiello. Oh, right, first time. He is the head fixed income portfolio management at a large European bank. Alfonso, how are you?
Very good, Rocco. Thanks for introducing me. It's a pleasure to be here.
One of the things that jumps out at me is two words: liquidity buffer. What exactly is a liquidity buffer in layman's terms for our listeners?
Yeah, I'll try to explain that. So after the 2008 crisis, as you well know, the banking system became much more regulated. There were bank runs actually going on in several places all over the world, and sometimes banks were not prepared for it. So literally they could not serve the client coming to withdraw his cash at the bank ATM. You might have remembered, for example, of Greece, where it happened a couple of times. So the regulator learned that, and after 2008 introduced a new metric, which is called liquidity coverage ratio, LCR. Yes. And this liquidity coverage ratio basically forces bank to have an amount of liquid assets on the asset side of the balance sheet, which is at least the same of a stressed metric for which basically clients might come and withdraw cash in a stressed situation. So what the regulator is looking for is to make sure that bank can service clients that are coming to withdraw their cash, even in a stress situation, by forcing banks to own liquid asset on the asset side of the balance sheet. So these liquid assets can be cash itself. That's very simple, because if you have cash, you just serve your client when it comes and withdraw it. Mm-hmm. Or it can be bonds, certain government bonds or corporate bonds, or other form of bonds are considered by the regulator as liquid as cash. So you can own them on the asset side of the balance sheet and have a portfolio of bonds, fixed income instruments, and cash as a result. By the way, I'll have to stress that in this interview, I am not representing my employer. These opinions are strictly my own, and please consider them as such.
Alfonso, let's shift gears a bit. There was an article last week in The Economist that called Europe the land that ambition forgot. I thought it was quite a clickbait title. Any care to comment a bit on that?
Yes, definitely. I'd have to say that if you're a global corporate today looking to invest all over the world or to open business, then there are a few places that might look interesting, and unfortunately, Europe does not shine on that perspective. So I think this is mostly driven by two things. Europe has a structural trend growth, so a capacity to produce a stable growth, which is pretty low. The drivers that influence this capacity of trend growth over the long term are simply demographics and productivity. So, because the birth rate and demographics in Europe have been dropping materially, like all over the world, but in Europe, it's sometimes in certain countries especially, it's pretty strong, these dynamics. Simply your labor supply year on year shrinks because you'll have more people retiring and less young productive people being able to replace them in the workforce. So you have a smaller workforce and a less productive workforce. Productivity has been low for ages as well, because it's very difficult in Europe to implement reforms to enhance its productivity. Just think about, for instance, of the French pension reform that France is trying to implement for now ages. And every time they try, every government that tries, we have large protests on the streets. Italy as well has been trying to implement reforms, but the only time it could was in 2012, basically, where we were on the brink of failing. And I say we because I'm Italian. So as you have an aging population with a certain propensity to save rather than to consume, if you're a corporate and you're trying to make business, it's going to be a hard environment. By the way, interest rates are also very low in Europe. They're basically zero. And the real interest rates, so corrected for inflation, are negative. So it means your purchasing power is going down if you don't invest your money. And that has led people to save more rather than to invest. It's pretty counterintuitive, but that has been the reaction. As real interest rates went negative, people started saving more. If you have an aging population with a large propensity to save, it's pretty hard for a corporate to actually open business there. And the second component I would add is, if you look at a metric, which is pretty nice, I think it's called Ease of Doing Business Index by the World Bank. Europe doesn't score well. And that's also because of bureaucracy sometimes, which tends to be pretty big. So, for example, pretty simply, trying to open your own small business in certain countries in Europe proves to be very, very difficult because of bureaucracy. So these two components, an aging population with a propensity to save rather than to consume, and bureaucracy, I think, are the biggest hurdle for corporates to actually invest in Europe.
But an aging population isn't inherent, right, to Europe. I mean, China just came out with legislation change from the one-child principle to the two-child, and now the three-child principle, trying to basically bring about some reform. So, I mean, Europe, it's not inherently something that's just in Europe.
And that's a good point, Rocco. But here, I think you'll have to look at the global corporate with a relative choice on where to invest and where to put these capital expenditures, basically, and expand the business. If you can choose between Europe and America or, for example, East Asia, which has demographics which look much better and a propensity to consume, which looks much better with the middle class actually rising, you probably would prefer the latter. So on a relative basis, because of relatively poor demographics and also relatively harsh bureaucracy, I think Europe is not the first choice on a relative basis.
That's a really insightful point. Last thing that I want to talk to you about is, as you are aware, El Salvador granted Bitcoin the status of legal tender last week. It seems like President Bukele has also adopted the quote-unquote laser eyes. Good or bad in your opinion?
Well,
loaded question. I know it's a loaded question, but let's unpack it a little bit.
Yes, let's do that. So I don't have a straight answer if it's good or bad, but I can help maybe the audience understand how the monetary system is today built and what does it mean to adopt Bitcoin as a legal tender in a country.
Perfect. Sounds perfect.
Thanks, Rocco. So the monetary system today is built on fiat money and credit creation. So what this means is that after 1971, where President Nixon basically scrapped the gold standard in America, there is no hard asset that is backing the currency or the money supply expansion of this fiat money that we use every day. It means that this money supply is completely elastic. You can extend credit, you can withdraw credit, and you can just do that basically at your own wish, as long as the population trusts the system. Now, what we tend to do is we like to extend credit every time. Why do we do that? Is because the structural component of trend growth, as I said before, are always the same. This is the labor supply growth and productivity growth. And as demographics was coming down, and sometimes also productivity is not as good as you think, this structural growth might look pretty poor. And we as humans like to basically live above our means. So what we do is we extend credit to basically overlay some cyclical growth on top of the structure. We borrow from the future consumption effectively, and then we simply leave the problem to the next generation. This is also because we have political cycles every X years, and every politician wants to be re-elected. So that's why you have few politicians that go for a deleveraging, and a lot of them that like leveraging, because you get the returns today out of basically borrowing future consumption. Now, the marginal returns of this exercise are obviously shrinking when you have an economy which is over-leveraged. Global debt to GDP, considering all sectors of the economy, is today 365% all over the world. Now, debt to GDP, by the way, is not a perfect metric because you are comparing basically debt to something which is a stock, which is GDP. You should rather compare it, I think.
Yeah, I'm with you.
The means you use to service this debt, which is simply tax payments. So if you consider global debt on tax payments, we're talking 700% all over the world. Now, if you have an economy which is so leveraged, clearly by adding more leverage, you will get less and less marginal returns out of this because you're adding unproductive debt. You're keeping afloat zombie companies. So this basically is being squeezed to as much as it can be squeezed. And that is why, Bitcoin or any other form of alternative assets are gaining traction. Now, if you would adopt a system based on, let's say, a Bitcoin standard, to say like it was the gold standard in the past, and you would assume that the supply of this Bitcoin is limited, what you are doing effectively is you are fixing the money supply and the credit expansion of this money supply to a hard asset, which is in theory limited in supply. Mm-hmm. Now, this is a very, very tough transition, because for the last 50 years, we have been used to a system where you can expand credit at your wish in a completely elastic way. Now, with the gold standard or Bitcoin standard, this is not possible anymore. So this is a system which is inherently deflationary. You might argue this is maybe better than the system we are using now. I don't have a straight answer to that. It's very difficult, but you have to understand that if you base your monetary system on Bitcoin or on gold, you cannot expand your credit and your money supply at your wish, because there is a hard asset that actually backs your fiat currency.
I think at the very least, this is going to be a very interesting experiment and something that has to be sort of watched as we go along, because we are in uncharted territory, are we not?
Yeah, for sure, you'll have to keep an eye on this. There are also other Southern American countries that apparently seem interested in the project. It obviously might bring to them a lot of publicity and some capital flows. And for that, I mean, if China is harsher on Bitcoin mining than these countries, then some people might decide to simply move their business of Bitcoin mining in these Southern American countries. And therefore, this is going to attract capital in those countries. It is for sure an interesting experiment. But the transition from a fiat-based, elastic credit supply-based system to any system like the gold standard was, where you peg or you reference your fiat money supply to a hard asset, is always a very tough transition.
Alfonso, thank you so much for coming on today. If our listeners want to follow you or connect with you, where can they do that?
They can subscribe to my free newsletter, which is on Substack at the following link, themacrocompass.substack.com. So the publication is called The Macro Compass. Or they can follow me on Twitter for more timely updates at MacroAlf.
I will put those links in the comments to our listeners. Peace, love, and prosperity. And I'll catch you in the next one.